view? How does what we're going through now compare to previous market events?
What's interesting about what's going on right now is that when you look at the typical downturn, whether it's in the economy, and the downturn in the economy quite often drives, at least in the short run, the adjustment in market value. So let's talk about the contraction in the economy. The typical type of contraction in the economy is something called a demand side contraction. And what it means is that you have three groups generating economic activity. You have consumers, which is the largest part, companies buying things, and the government buying things. So if, let's say, consumers are pulling back either because unemployment is higher or because they have expectations are not good about the future and they're not buying as much, well, companies are not producing as much, and that draws the economy into and the way you normally solve that is that you give a tax break, you give consumers some money, they buy more, companies and factories produce more, and the economy rebounds. That's a typical type of economic downturn that happens on average once every 10 years. It's a demand side, and that's what we saw back in 2009, 0809. Now, that's one type. What we see today is not only a demand side crisis where people are not buying enough because they're just, it's not the right time. We also see a supply side shock. And what it means is that even if we want the economy to produce, it just can't because the workers are stuck at home. And in that respect, what you heard of the government passing a stimulus package, that's not the right word, because stimulus is designed to stimulate. You spend money, you stimulate economic activity, the economy goes up. That's not possible because even if people are spending, you can't stimulate the economy because there's nothing to stimulate. Everybody is stuck at home, so you can't produce anymore. And this type of both demand and supply shock, it doesn't happen very often. In fact, over the past century, looking through economic history, we only find 3 instances when we had both a supply and a demand side shock. And it might be instructive to go through those, and particularly since the first one is it's quite a resembling of what's going on right now. And that is 100 years ago, as a country, and also as a world, we went through a pandemic. And it was a Spanish flu. And there are certainly many, many differences between this pandemic and that one. That one actually impacted people in their prime. It was 18 to 40, whereas this one tends to impact less that category. The world seems to be a little different than it was back then. But what is incredible is to see the similarities and things that look so familiar. Once again, we had a virus. It was a bug. We couldn't treat it back then. We can't treat this one right now. But it's the response of the governments and what the economy did that is so interesting. And if we're going to go back to those days and see what is similar, there are differences, but what's similar? The first thing that's striking is that if you take a deeper look, is the way that they try to contain it is through social distancing. Exactly the same thing that we are doing today. It's exactly the same thing that they tried to do 100 years ago. And what they did, and it's again so interesting, back then the first city to close churches and schools and all gatherings was Seattle. And so was this time around. And then it wasn't just Seattle, it was followed by pretty much cities around the world and the country. And everybody was required to wear masks. And there was a police force to make sure that everybody is wearing a mask. You couldn't even get on the train without a mask, pretty much like today in many, many ways. The suggestions that we got were not unlike what we see today. Don't be around sick people. Wash your hands. There's the one about don't spitting or put your fingers in your mouth. Okay, maybe we kind of got past that one. But in many, many ways, it is eerily similar. And there was a paper that was published about a month and a half ago by 2 economists from the Fed and a PhD from MIT, looking at the cities and how they responded. And back in those days, same as today, cities had latitude for how long they shut down and how early or late they responded. And what the paper found is that the cities that shut down early and they close longer, and let's define that. short end was about 2 months. Long end was about 4 months. The average of a closure, of the economic closure, was about 90 days or 3 months. Very, very similar to what we'd like it to experience this time around. And what you saw is that cities that took care of it, like St. Louis, that's a shining example. They actually, not only that they had much lower mortality rates, but at the back end, they came out economically stronger than cities that did not really take it seriously, and they did not shut down as long. And the big example there is Philadelphia. They had a 250,000 people parade, knowing this is going on, and even though they were warned, don't do it, they just did it. Not only the mortality rate just skyrocketed, but also economically they came out very badly. Why? Because you can open the city as much as you want. You can't tell me, you can't force me to go out. If I don't feel safe, I won't go resume my normal life. So yes, you can open the city, but if people don't feel safe, they're not going to go out. And that's what you kind of saw with the longer term. People felt like we took care of it, so we're more likely to go back to what we used to do. So it's so interesting to see the parallels. And then of course you say, well, today we have the internet and we have Zoom, like what we're using right now, or WebEx or Microsoft Teams, whatever it is. And we also have Netflix to entertain at home. Well, what's so interesting is that's pretty much what happened back then in a different form. You couldn't shop over the internet, but there was a phone. Stay at home, shop by phone. The theaters are closed, but instead of Netflix, there was this concussion that the dog is staring into, and that's bringing the world's greatest artist in your home. And if you have a telephone from the good people at Bell, you're not isolated. Very, very similar to what we're going through right now. And the last comment about this is, if you look at what happened afterward, and this is a lesson, is that as a society, we figure it out. We got through that. They're really tough days, but what followed were not like the depressing, horrible 20s. It was something that's known as the Roaring 20s. And in the Roaring 20s, people went back to doing what they did. They had cocktails, they started congregating again, and the factories and manufacturers just absolutely took off. Cities were vibrant again, and as a whole, it's known for just a very vibrant decade in American history. And maybe this is hopefully what's in store for us, the Roaring 2020s. But I do think that this is a pretty interesting way to look at it. So that's the first time that we saw a supply and a demand shock. The second time we saw the supply and demand shock was during World War II, because 11% of the U.S. workforce was pulled to support the war effort. And you had a large group of people. I mean, 11% of the workforce just not being there anymore. Obviously, the economy can't produce as much. And as a lesson is that, it's the spirit of the country and how we dealt with it. And it's something that has implications all the way to today, which is that back then realized that a way to be able to produce all the things that we needed to do, maybe it was a good idea to involve a group that had not been part of the economic production up until that point. And to me, ever since then, we kind of realized that women can do exactly the same jobs as men. And he had Rosie the Riveter, and everybody contributed. And to me, it was a watershed moment, because ever since then, we've been inching towards that goal. It's just, hey, every job and the pay should be the same for men and women. And we're certainly not there. To me, the watershed moment is the realization, anybody, women can do exactly the same job as men can do. So it is with us today. It's a lesson about the spirit of the country, but there are other lessons that we can pull from this as well. And the first lesson is that in the stock market that we operate, something that happened back then, it's also happening today, which is that in free markets, in a capitalist world, companies will find a way to make money in whatever state of the world we're in. If they cannot sell cars, guess what they'll make? They'll make tanks. If they couldn't sell toys, they probably make bullets. That's what we see today. Distilleries making hand sanitizer instead of brewing spirits. Ford and GM, they're repurposing assembly lines to make masks and ventilators. And that is with us today. And it's so amazing to see this dynamics of free markets and capitalism. The other big lesson is that you got to be careful about you know, when things look gloomy, and you look as an investor, you got to be careful that you're not a bit overreacting and keeping some perspective. And what I mean by that, if you're going back in time to 1937, the U.S. market dropped by not pretty much as much as the great financial crisis, very steep drop. And then you kind of get a sense that we're going to get into a war. And then we had a rebound, but then it was followed by another 3 years of pain. So by the end of 1941, when the U.S. enters the war, 4 out of the last 5 years, the market was down and you lost a lot of money. And imagine that you are sitting in the living room and you are basically in a dimly lit living room with a radio kind of blaring the bad news. We just entered the war, and you're kind of thinking, boy, this does not look good. I've lost 4 out of the last 5 years. I've lost money in the market. The war is killing millions of people. Cities are being destroyed. My neighbors are leaving and not coming back. And it's really tough. And how would you have felt as an investor? Is that the right time to invest? What's remarkable is that during the darkest days of our parents' generation, the U.S. market had a stunning result. That over the full war years, not only did the market didn't go down, but it grew on average of over 22% per year on average during the darkest days. And it's so interesting because, again, it's a forward-looking exercise, and these companies figured out how to do it. But as an investor, if you're sitting there as the U.S. enters the war in 1941 in December, you're kind of saying this can be good. And yet $1 invested at the beginning of the war would have doubled by the end of the war. So, you know, put some perspective. Things might look bad, but it doesn't mean that these companies won't find a way to make money. CEOs might work out of their pajamas right now, but they ultimately have the same goal. How do I get this company to make money again? And if you own a piece of it, you're just along for the ride. So that was the second time that we saw the supply and demand. We had a pandemic in 1918. We had the World War II. And the third one was in 1973, when a conflict in the Middle East led to an oil embargo against the U.S. And what you saw was a huge oil shock and a supply shock, because we just didn't have enough oil and the price just skyrocketed. And you had people waiting for hours and hours, sometimes with no gas. And that was a big supply shock to the economy. And to me, what's the lesson of that? What happened afterwards? The big lesson, there are 2 lessons. The big one is that we changed. This will change us the same way that the 1973 crisis changed us. How did it change us? 2 ways. One, as soon as the crisis is over, we realized as a country that we cannot keep driving the same cars. So there was a law passed requiring better fuel efficiency. And what we've done is moved as a country from the gas guzzles of the 70s to the much more fuel efficient cars of today. The second lesson is that we realize that this whole economy depends on a commodity that comes from countries that are not always friendly to us. And we realize, well, we need to start actually making some of this at home and be more energy independent. And if you fast forward, the result is that today, the U.S. is the largest oil producer in the world, more than Saudi Arabia and Russia. And why is it a lesson for us today? We will change after this. Some changes will be in the short run, some maybe for the long run. It's also possible that the companies will look at this freewheeling supply chain and say, maybe it's not as reliable. But secondly, maybe there should be a national security component to this. And this event, this crisis, might be the trigger of the rebirth of the American manufacturing industry. And we might look 20, 30 years down the road and say, well, you know, we kind of realized that we need to produce stuff at home. And this was the trigger that made that shift, the same way that we had it with oil. I don't know, but it's quite possible that could happen. It's just a matter of learning. We are learning, and we're trying to change, and there will be change without a doubt. So those are the 3. It was a very long answer, but to me, those are the 3 times: the Spanish flu pandemic, World War II, and 1973, when we saw a similar supply and demand shock to what we have today.